The benefits of integrating insurance products, solutions into your retirement plan. I know this is going to drive some of you nuts because you've been chirping at me through the messages on YouTube or on Instagram saying, all you're trying to do is sell life insurance. You're just trying to sell life insurance. I know what your angle is. Yeah, I am trying to sell life insurance because life insurance is sold. It's not bought because there's so much disinformation out there on how life insurance can be, or insurance products can be properly structured and implemented into your retirement strategies, into your overall financial planning strategies. Now, and I've done videos about the problem of, the lazy, ignorant, and greedy life insurance agents. I've talked about bad products and bad product design. In fact, I'm working with some clients right now to try to help them get out of a bad life insurance product because the company that they were with got bought by a private equity firm, and the private equity firm doesn't care about the policyholders. All the private equity firm wants to do is raise the COIs, drop the caps down, and screw the client over. But what if I told you that there was one of the big four? So the big four are Deloitte, KPMG, PwC, and then we've got Ernst Young, EY. They did a research paper on how integrating insurance products into your retirement plan can be beneficial. And not only did they just do a research paper, they have data, statistics. And like I tell people all the time, this is math, not magic. And so if you are arguing that insurance doesn't work or it can't work, how are you going to argue with one of the biggest advisory firms in the world that employs over 350,000 people in 150 different countries, has been around since over 100 years, 150 years. One of the most respected, all of the major Fortune 500 companies use it. A lot of ultra high net worth, 100 millionaire, billionaires use EY as one of their advisory, audit, tax firms. How are you going to argue with their analysis of it? So don't take my word for it. Let's look at what they say, right? And so let's dig into it. So Ernst Young researchers estimate that by 2030, a little over 5 years from now, there will be a $240 trillion retirement savings gap and a $160 trillion protection gap. And that financial advisors and insurance providers, but financial advisors like me, who know the power of this, that haven't drank the Kool-Aid that it's investments only and that life insurance sucks and life insurance doesn't fit anywhere, that people like me, I'm uniquely positioned to address these gaps with products that offer legacy protection, tax-deferred savings growth, and guaranteed income for life. This is how they start their paper, with products that offer legacy protection, tax-deferred savings growth, and guaranteed income for life. It goes on to say, and I'm not going to go through the whole thing. In fact, if you want a copy of this report, DM me or message me EY report in the message section, and I'll send you the link. EY report if you want this. It goes on to say, permanent life insurance and a deferred income annuity with increasing income potential represents diverse opportunities. The analysis focuses on whether integrating permanent life insurance and a deferred income annuity, a DIA, with increasing income potential, IIP, into a financial plan provides value relative to an investment-only strategy. So does integrating life insurance products, permanent life insurance, and a deferred income annuity with increasing income potential components to it or riders to it into your financial plan, does it provide value relative to the investment-only strategy? And they did case analysis and case studies that I'm going to walk you through here. Remember, if you want this report, message me EY report, and don't forget to like, comment, share, subscribe to this channel so we can keep this thing going. So here's the 5 strategies in their analysis. They did investment only, which is self-explanatory. I don't know if I have to mention that or explain that to you guys, but that's equity and fixed income assets only. Then they did term life insurance, just term life insurance with investments. Then they did permanent life insurance with investments. And then they did deferred income annuities with the increasing income potential component with investments. And then they did permanent life insurance plus the deferred income annuity with increasing income potential plus investments. And so that's the integrated strategy that they're going to talk about. So further, they use, or EY uses, permanent life insurance as a volatility buffer. Listen to this, because I've talked about this in previous videos. You can check some of them out here if you want to. But EY, Ernst Young, advisory firm across the world, one of the big four, uses permanent life insurance as a volatility buffer, meaning that permanent life insurance cash value, which can be accessed via loans, which I've talked about before, the characteristics of permanent life insurance, the characteristics of a savings account. So the volatility buffer is used to fund retirement income during periods of market volatility. In other words, when the investments and the equity investments are getting crushed due to the equity markets going down, you can take those loans and those distributions from the permanent life insurance policy as a volatility buffer. This allows investors to avoid liquidating assets from their traditional investment portfolio that have fallen in value. Buy low, sell high. When things are going down, you don't want to be liquidating those for income purposes. Again, stuff I've talked about, I will continue to talk about till I'm blue in the face, to help you guys understand that, yes, I am selling life insurance, but doctors sell pharmaceuticals. You don't say, oh, you're just trying to sell pharmaceuticals. Well, some people do. But this is about, I have access to something that you don't have access to. I'm trying to educate you on how this works. Take the education, take the medicine. It's there for a reason. Okay, the process on what the strategy did, on what the research paper did. To compare the 5 strategies, and remember, the 5 strategies that I just talked about are investment only, term life plus investments, permanent life plus investments, the deferred income annuity plus investments, and then the last one is preferred life plus deferred income annuity, or permanent life plus deferred income annuity plus investments, okay? So what they did is they ran a Monte Carlo analysis to generate 1,000 scenarios, each of which contains a time series of interest rates, inflation rates, equity returns, bond returns across the planning horizon. And they analyzed 2 outcomes. The first outcome is an after-tax retirement income that can be sustained at a 90% probability. So what that means on a 90% probability, it's most likely going to be a moderately allocated account. So a certain portion of fixed income, a certain portion of equities, not terribly aggressive because it needs a 90% probability of success. The income is derived from systematic withdrawals from the investments, the dividend income from the deferred income annuity, and then surrenders or policy loans from the permanent life insurance cash value. Income taxes do not apply to any cash flows from permanent life insurance. Look, it says it right here. So I'll go back a sentence. When calculating retirement income, we apply ordinary income tax rates, federal and state, to withdrawals from the qualified assets and the deferred income annuity. The next sentence says income taxes typically do not apply to any cash flows from permanent life insurance. And I've told you guys this, the characteristics of the permanent life insurance. It has 11 of the 12 characteristics that we're looking for. One of them is tax-free distributions. Okay, again, what do I know? I'm just trying to sell life insurance to everybody. This is one of the most highly respected firms out there, one of the big four, research analysis. They don't sell life insurance. So what's their dog in the hunt for this, right? This is an unbiased report that they put out. Again, message me EY report if you want this and I'll send this to you. The second metric is the legacy value at the end of the time horizon. So the legacy value is calculated as the sum of the total face amount of the life insurance that's in force at the time, the investments, the after-tax on the qualified assets, the estate taxes, if applicable, okay? So let's start with the first case study, and I'm gonna set this case study up. It's gonna take a little bit of time, but let me set this up. So we have a 25-year-old couple. They have an $80,000 salary. They're putting 20% of that into savings, all of that going into qualified plans. They've got very little to start with, $45,000 total savings. 35,000 of that is in qualified money, most likely 401ks. 10,000 of that is in after-tax accounts, and they have 70 years for their time horizon. A 25-year-old couple has a 70-year time horizon, okay? Think about that, 70-year time horizon, all right? And this is what the different models would look like. So you have the investment-only model here, which is a 50-50 split between stocks and bonds. You've got term life plus investments, and the term life doesn't factor in here because it's not an investment or it's not a savings account, but there is a fee associated with it in this column. Then you've got equities plus bonds, plus a little bit of permanent life insurance, deferred income annuity. Then you've got bonds, equities, more of a deferred income annuity. Then you've got permanent life insurance with the deferred income annuity plus equity and bonds, so on and so forth. And it's changing the allocations and the percentages in these models. Point number one to make, and I highlighted it here in green, permanent life insurance plus investment strategies outperform investment only and term life plus investments. I'll read it again. Permanent life insurance plus investment strategies outperform both investment only and term life plus investments. So when you add in permanent life insurance to the investments, it outperforms these two here on the left, investment only and term life plus investments. How? Well, here's what that looks like. They did all of this breakdown. So they have the investment only analysis that provided for them. And the assumptions are right here, right? I'm not going to go through all of the assumptions. And I laid it out for you, 20% of the salaries are savings, blah, blah, blah. But the investment only provides a retirement income of $61,250 a year with a legacy at the end of the time horizon of $3 million. Okay, that's the starting point. That's the benchmark that we're trying to compare against. Whether you add in 10% permanent life insurance to your investments, 30% permanent life insurance to your investments, or 50% permanent life insurance to your investments, they not only provide more retirement income, but they also provide more legacy at the end of the time horizon. But yet you're being told life insurance is bad. Don't use permanent life insurance. Dave Ramsey, life insurance is horrible. In fact, Dave Ramsey says, buy term insurance. Oh yeah, well, let's look at term insurance. When you add term insurance to the strategy, it is less income at the end of the time horizon and less legacy at the end of the time horizon. And why is that? Go back and look at my lazy, ignorant, and greedy video on life insurance agents. There is a specific way to structure life insurance, just like there's a specific way to structure an investment portfolio. You don't just blindly invest in something. Well, the same thing is true about life insurance. You don't just blindly buy a life insurance policy from anybody that can sell you one, okay? There's a couple reasons for this outcome. For one, permanent life insurance, and again, I'm reading it right here. Permanent life insurance tends to provide superior returns over a fixed income in the long run scenarios due to the combined effect of the guaranteed growth of the cash value. But what do I know? Term life premiums do not boost long-term savings, instead acting as a drag on the portfolio performance. Less than 97% of all the policies written have ever paid a death claim. I don't know where I got that statistic from. I could be off, but if I'm off by a percentage point or two. I'm not off by a lot. The second reason is that using permanent life insurance as a volatility buffer improves returns because the investor does not have to sell or withdraw or realize losses on their investments. When it's down, don't take money out of your investments. Let's use the permanent life insurance policy to do it. It has cash value. This is good stuff. Now, let's turn our attention to strategies that include deferred income annuities, okay? So deferred income annuities with the increasing income potential, right? These strategies outperform other strategies in retirement income. And here's what it looks like. When you add a deferred income annuity with the increasing income potential, with the investments, it really does. Look, instead of just the investment only income of 61,000, it's 63, 64, 66,000 of additional retirement income. On top of that, it's a 3%, 5%, 8% increase. Plus, it's an increase of the legacy at the end of the time horizon. Think about that. So the deferred income annuity with the increasing income potential with the investment strategies are more focused on retirement income. Now, the next one is when we incorporate permanent life insurance with the deferred income annuity with the increasing income potential to our discussion. So let's find that out. So when you add permanent life insurance, this is the integrated strategy now. Integrated strategies are more efficient than investment-only strategies. Integrated strategies are permanent life insurance with the deferred income annuity with the investments. When you add in 30% permanent life insurance plus 30% deferred income annuity with the investments, Your income is up 5% to 64,000. Your legacy at the end of the time horizon is up 18%. If you added 50% permanent life insurance, you're still up with the 20% increase on your legacy at the end of the time horizon. And then if you added the 30% DIA with the investments, you're up 8.2 with the, so the analysis suggests that the investment only strategy is inefficient from a retirement income and legacy perspective. I'll say it again. The analysis suggests that the investment only strategy is inefficient from a retirement and income perspective. An investment only strategy underperforms permanent life insurance and investments. It also underperforms a deferred income annuity with the increasing income potential plus investments. Investment only also underperforms permanent life insurance with the deferred income annuity, but you guys think I'm out here just trying to hawk life insurance products to you. And then there's the scatter chart, or you want to be in the northwest quadrant, and the balance strategy, the deferred income with the permanent life insurance with the investment is in this top left or top right hand quadrant. And then point number 4, integrated strategies provides investors with the flexibility to focus on the financial outcomes most important to them: retirement income, legacy, and balance between them. That's what you want. That's what this is about. So I'm looking at my time here. Let's keep going, okay? Point number 5, allocating up to 30% of annual savings to permanent life insurance. So of the amount that you're saving per year, Ernst Young is recommending you allocate 30% of that number to permanent life insurance. And then when you hit age 55, take 30% of what you've accumulated at wealth and move that into a deferred income annuity with increasing income potential. That may be appropriate when optimizing retirement income and legacy. Ernst Young finds allocations between 10 and 30% are generally supportable to permanent life insurance. A higher allocation to permanent life insurance may still be appropriate for an investor solely focused on maximizing legacy, but the corresponding reduction to income can be substantial because the permanent life insurance allocation redirects too many assets away from the equities, right? So think about that. This is not me selling you. This is Ernst Young's research paper on how life insurance products integrated into your retirement plan will not only increase your income, but also increase the legacy that you leave. So that's the 25-year-old couple. Point number 6, for investors with a higher risk appetite, the integrated strategies still remain better than investment only. Overall, integrated portfolios still provide better income and legacy benefits relative to investment only and term life plus investments. So that's the 25-year-old couple. Real quickly, let's go through the 35. Remember, like, comment, share, subscribe. Also remember, EY report. If you want this paper, EY paper, EY report, DM me, message me, and I'll send this to you. So what's the outcome for a 35-year-old couple? I mean, $192,000 salary, saving 20% per year. They've got some $230,000 of money saved up. Still, most of it's in qualified plan. Again, the scatter chart or the blot chart suggests very similar to the 25-year-old couple. 30% in permanent life insurance plus 30% in the deferred income annuity with the investments provides 3.5% more income than investment only and 16% more legacy at the end of the time horizon. The majority of the integrated strategies produce higher retirement income and legacy at the end of the time horizon, while the 2 exceptions provide slightly less income, but much higher legacy. What about a 45-year-old couple, right? More income, savings, more net worth, more money that they've got saved up. It's still the same thing, right? All but one of the patterns and trends remain for the 45-year-old couple that was with the 35 and the 25. The integrated portfolio producing the most retirement income is no longer just the deferred income annuity with investments. Rather, think about this, for the 45-year-old couple and older. So if you're watching this and you're 45-year-old couple and older, if you're younger than 45, the best strategy is the deferred income annuity with the investment strategy with the small piece of permanent life insurance. But for the 45-year-old couple, it's the 30% permanent life insurance plus 30% deferred income annuity with the investment strategy. because an older couple has relatively less need for equity exposure. In other words, more exposure to permanent life insurance and deferred income annuities with the increasing income potential produces better retirement outcomes because it does not result in an under allocation to equity assets. We conclude that the findings above for the 25 and 35-year-old couple also apply here to the 45-year-old couple. Note that this observation is a function of the glide path assumed in the analysis, the Monte Carlo glide path. If an investor, or the Morningstar glide path, if an investor uses more conservative glide path, then it is likely that the higher allocations to insurance products at younger ages will provide better retirement outcomes. This is them, not me. If you want to buy a life insurance policy now, reach out to me. Schedule an appointment in the description section with me. This is Ernst Young telling you the benefits of integrating life insurance products into your retirement plan. So think about this. The analysis shows that integrating insurance products into a financial plan provides value to retirement investors. We can use these products to strengthen our relationships with you guys and seize the opportunities in the marketplace that has proved challenging, because it is challenging. I'll go back to the very top of what this says. There will be a $240 trillion retirement savings gap and a $160 trillion protection gap by 2030. I am uniquely positioned to address these gaps with you, with products that offer legacy protection, tax-deferred savings, tax-free distribution, and guaranteed income for life. Reach out to me, DM me if you want this report, EY report, in the message section. I hope you found this valuable. This is Ernst Young saying it, guys, not me, but I'm just a life insurance guy. What do I know? I'll see you in the next video.